Welcome back, and thank you for still staying there with us on Cosmopolitan Market. If you're just joining in, this is Cosmopolitan Market on Nigeria Customs Broadcasting Network, channel 193 on Star Times. Always a pleasure to have you tune in. This is the conversation segment of the program, and I have my guest with me live in the studio. He is Professor Ken Ife. He is Chief Economic Strategist at ECOWAS and also a renowned macroeconomic analyst. Welcome to the program, Prof.
Thank you for having me.
Always a pleasure having you on the program.
Thank you.
Now, Prof, I know you have seen the GDP numbers. We spoke about it yesterday when we were having a conversation. 0.51%. Did that come as a surprise to you?
No. I actually expected a higher order, around 1%. But that's still very good. From 0.11 to 0.51 is quite a jump. But I had expected a 1%. But still, we'll still get there. Maybe in the next quarter.
Prof, you're quite optimistic because I was reading some reports before I think sometime last week, and there were a lot of predictions of contraction in the first quarter of the year 2021. Why do you think there was the prediction came in that the economy was going to contract rather than grow?
No. I've always, since last October, predicted that we will get out of it in December. And there were so many signs there because we were in harvest season. And there's so many signals that it was going to happen. And even now, it could have been more if not for the fact that we are now in planting season.
Yes.
And this is when the food is more costliest because of planting activity by farmers and all that. But that goes more to inflation than to agricultural growth rate.
Yes.
But if you look at the figures, you could see that there's movement on literally half of the sectors, especially the oil came back strong, even though it's still in the negative territory, but it was quite a big jump from where it was in the fourth quarter. So the signs are there, and for the first time, transportation, which has been aviation that was minus 57 this time last year, is now just about to break even, just about to come to zero. So it's a big, so it shows you a lot of recovery from the aviation sector, despite the COVID thing. More people are buying more planes. There are lots of stuff going on. And many other sectors are also showing positive signs, like the hospitality and accommodation.
Yes.
There's also food, also. And they are also growing, and very close to break. And the industry that was very, very poor, -7, they are now very close to breaking even, very close to zero. So that's also good news. ICT surprised me a little bit to have dropped to just under 8%, from 15% in the last quarter. But it's nothing to worry about. You see the highest growth that you can see in the sector. And quite remarkably, the oil bounced back also in contribution to the GDP, which was under 5% but now about 9.2%. So that's a significant drop. And of course, the production volumes have also increased, relative to what it was before, but still not near the target. So prices have also come up really strongly, the crude prices.
Yes.
So the combination of both means that we will see.
Because I was just going to ask you that, Prof, that do you think this growth we have seen, 0.51%, is as a result of the fact that we are seeing some stability returning back to the international oil market?
It has a lot to do with it, because don't forget that the main growth was driven by non-oil sector, and even then they still posted a positive growth, but the oil came back, still in negative territory, but very, very close to, and quantitatively, it made a lot more sense in terms of production volume and rising price. So those two will give you a higher GDP contribution, which we saw, jumping from less than 6% to 9.2%. So it's quite a jump. Then agriculture and industry also. Agriculture slowed down a bit, but still better than before, because for the first time in many years, in the last quarter, it went to 3.6, rather, for the first time exceeding population growth rate. But now it just dropped to 2.2, I think, something like that, about 2.2. It's still okay, but it's below the population growth rate. This is not where you get the highest growth for agriculture. It's towards the end of the year when you have the harvest season.
True.
This is usually the worst time, but still Still positive.
Prof, I still staying with the subsector aspect of the report, especially with our Greek sector now. We know it is no longer news that insecurity is really affecting the sector, and we are seeing slow activity, the growth we are seeing, that is slowed growth in the agricultural sector. Now, I want you to, how would you appraise the policies now? We know insecurity is a challenge on one hand, but the policies targets towards growth in the agri sector. How would you appraise the impact vis-a-vis this report that we have seen now?
No, look, let me tell you something. This is a nation at war in 6 geopolitical zones, and it's an asymmetric warfare. That's one.
And many might not want to agree with you about the nation being at war.
Decimated many sectors, particularly agriculture, because not only are there huge displacement of farmers to IDP camps, but you have a shrinking agroecology. And at the same time, Nigeria is 200 million, but we are feeding 300 million people, including the surrounding Francophone countries, Niger, Mali, the other one, Chad. We are feeding these people. That's why you have massive fleet of our food going up north there. So it's very big challenge. And one of the drivers of that movement of food out of the country, is because of the foreign exchange differential. Now, we used to buy 3 francs CFA with 1 naira, but now you can only buy 1.2 francs CFA with 1 naira. So you can see, to them, it's devalued about 60 to 70%. Yes. About 70%. So anything sold here is cheap. And that's what they import. They don't import other things, though there's some areas you have some finished products going out too as well. But that's the market surrounding us. But the food is so important to us. But there's nothing you can do about that, because the ECOWAS treaty allows free movement of food, and you can't tax those because they're protected by the treaty. So that's that. But there are other areas that are heavily affected by the conflict. The conflict is the key driver of the negative growth that we are seeing across many sectors. But in terms of agricultural policy, I think for decades, the challenge with our agriculture are many. But the key factor that I see is that whilst FAO recognizes Nigeria as one of 5 countries in the world that produces more food than they require, the historic challenge has been that 30 to 70% of what we produce never make it into the food chain because of post-harvest losses, inadequate transportation infrastructure, storage infrastructure, lack of enough power to dry it. So all of those, but now they are now compounded by security. And the dimension of that security is, African Union in 2012 says that women account for 80% of the production of staple food. And they account for 80% of the processing of those staple food, and 80% of the retail of these in rural and urban markets. And when these people are now endangered and they can't go to farm, they can't go and plant, they can't go and harvest, it's tough luck. And then you have a shrinking agroecological footprint. So it's tough. So you have to meet that with mechanization, intense mechanization, clearing more lands in safer areas, and then bringing in better variety of crops that will increase you. So there's a lot more. And CBN has been on that case. It has been on that case because what we had was archaic agricultural production systems with subsistence farmers. But now, those subsistence farmers have now become commercial farmers. Over 5 million of them now. With access to finance, just using their BVN, and they are now integrated into an organized national and global supply chain. So you have an anchor that is making sure that those army of farmers are getting the right seed, getting the right fertilizer mixed to the specification of their soil, herbicides, insecticides, and mechanization services, and then off taking all the produce from them. They don't have to carry produce all over. They will come to them and take the produce. So it's all in the funding frame, and they don't have collateral to bring. So they are being done without collateral. So it's a heavy transformation that we haven't seen. It's a revolution in the agricultural sector. And we have to be grateful to the administration and, of course, the central bank for doing this. And we wanted to do more. Because they're doing this in 10 agricultural value chain, presidential value chain. We wanted to do more. But even like oil, as you saw in the program, is so critical. If you plant one tree of oil or rubber, the oil is there for 150 years. So it's there for much, much longer than the person who planted it. So we have to spend pour more resources in there. Not only because of the economics of it, because it costs about 4 times more. The price, prices are about 4 times more than crude oil. And you can never have enough of it.
Sure.
Crude oil, as you know, is on its way out, but not for that.
Prof, is crude oil really on its way out?
Well, when I say relatively, but it might come faster than we think. Anyway, when we say way out, it means it will cease to be the major contributor to our foreign exchange. Yes. Many countries may not be interested in importing them because they already substituted quite heavily. And so we will continue to use it in this country for 30 years. And maybe some of the plastic products produced from there can still be exported. But anyway, but it's not going to be business as usual.
I like the fact that you brought in this dimension of the discussion, because just like you saw in the report before you came in, the president of UPGAN, Joe, he was actually even telling me that other countries like Japan, now use the palm kernel shell to produce electricity, to generate power.
Correct.
So that goes a long way to further buttress your point that there's the crude oil. I was reading a paper that said we might eventually drink our oil if we don't do the right thing at the right time. Like you have said, the black gold might not be as sustainable as we thought it would be. Now, one cherry part of the report, Prof, that I want you to also speak towards is the manufacturing sector. Now, we saw that the manufacturing sector exited negative zone and entered into positive growth path. What do you think? What would you say influenced this move?
It could have actually done much better if it has enough foreign exchange, because about 80% of our manufacturing capacity depend on some form of imported raw materials, yes, or even spare parts and equipment. So, and we have serious crunch. We have forest crunch. So they're not getting as much as they will need, even though what we have is significantly being given to them, over 40%. But when you look at the refined crude being paid for by our foreign exchange, is criminal. but it's happening, and then you have all the subsidy stories going on. So now, some of them have to now import by going to the black market to buy their currency, and that increases cost significantly. And then you have inflation pass through, and that affects their competitiveness, because they are producing at a very high input cost. And then how do you compete? You are competing against products that are subsidized to enter our country and undermine your price, and and our tax system is not reflecting that, because we are locked into ECOWAS CET, yes, and you only have to use levy instruments, yes, to augment if you want it to. So it's very, very tough. Of course, you have to contend with smuggling as well. Even if you try to raise the absolute tax, they still smuggle them in. So it's not the best of time for our manufacturers. And then also there's also flow of capital. Initially, the dynamics in the capital market was such that with the low yield on securities, yes, including all our, the money came down, the interest rate came down, so they started moving into the stock market. Yeah. But now they are moving out because they are being conscious of the difficulties the manufacturing sector is facing. And their challenges, and that's hitting their balance sheet. So again, investors are moving, looking for a safer haven for their investments, given the high interest rates, so the high inflation rate.
Prof, I want you to also speak to what are the fundamentals of growth that we need to put in place to ensure that we stay on this positive trajectory path.
No, I think the infrastructure is first of all, the security, everybody knows. Without security, nothing happens. In fact, the security is knocking the confidence of investors completely, foreign and domestic investors. But besides security and the high unemployment, of course, the area that government has actually been tackling is infrastructure. That's why we are borrowing so much money. And you can see the money going into rail network, new standard gauge and the refurbishment of the new narrow gauges, and then the thousands of kilometers of these. Do you know the last time there was investment in rail infrastructure was 1927? So, but this is happening now. And you have seaports, the maritime, deep sea ports. You have airports, the 5 international airports having new terminals,
yes.
Over $800 million. And then you also have the highways and bridges, and you've seen those. So there's a lot of activity at the infrastructure side. Of course, you've seen the power, even though they're augmenting the private. The power, there are investments going on with Siemens coming in and all that. So the government has continued to improve the infrastructure. It costs money. And then it's even more money than you would have projected. And don't forget that being in this kind of war in all the zones, normally many countries would just go and impose 30 to 40% war tax and tell citizens to pay that.
Prof, let me just...
Or even go and borrow $100 billion
Prof,
to fight the war. But we're not doing that.
When you say war, Prof, explicitly tell me, what do you mean?
War means that there is all kinds of conflicts in different zones. I don't know how bad it could be when thousands of people's lives are lost every year from deliberate attack, but it is asymmetrical. So it's very difficult for government to fight this war because of the nature of the war. You don't know who your enemy is. They are not dressed in uniform. There's no battle line. They just spring up one midnight and then they massacre people and then you are chasing shadows. It's an asymmetric warfare going on. You know where they are. Banditry in the northeast. They're even 2 hours away from Abuja. So it's not the most comfortable of times. But then also the government has resisted imposing unnecessary tax just to augment the revenue, to be able to deal with the other side of the story, which says that yes, you are borrowing within limits. Within 21%, which is between the limits benchmark. Benchmark is 40 to 6%
yes.
of the GDP, but we're 21%. So we're okay on the headroom, but it's the other side that is the repayment for the loan, which says the debt service ought to be around 40%, but we are over 40, 50, 60, going up and down. And then all the government could have done is say, look, if our government tax revenue is only 6% of GDP, why don't you triple it to come to the level of 18%, the average in the continent? If you do that, you are going to punish more the people that are paying tax. So you widen the tax base. And don't forget that just less than 2 years ago, we removed the tax for MSMEs less than 25 million.
Yes.
So it's so difficult to be doing all that and still find the money to do all the things that tickle our fancy. And when COVID hit last year, it shocked everybody. It disrupted the supply chain. We predicted 60% drop in the revenue, and there was a huge drop in the revenue, and the budget was cut down. But eventually, we'll spend more than they budgeted in 2020. So, it's difficult to just condemn the government for not doing better than they are doing. But there are areas where they are successful, which is on the infrastructure, and they've created a company. Infrastructure company that is going to take charge going forward with 1 trillion capitalization, and it's going to be heading out to the market for 15 trillion. In the agriculture sector, we've done well because you've seen major transformation in this sector. We could do better by getting more private sector big boys in. And they are getting in. Dangote is on the 50,000 hectares of sugarcane. Bua Group, 20,000. You have Ola, 50. So those big boys are coming in. The more the merrier. Because that means that you are sorting out the longer-term future of commercial agriculture.
Prof, are you rattled that for some time now we have seen a GDP growth rate that is lower than population growth rate?
GDP growth rate has always been lower than population growth rate. Has it not? Population growth is 3.2%.
Yes.
Our GDP has been over the last 5-6 years. It's still been below that. But it's not the only answer, because GDP is a number.
True.
People will tell you that growth is also a number. You can have paper growth and you still have poverty, all over the place.
Yes.
But I think in that respect, even the extreme poverty, which we believe is over 80 million people, it could have been worse if you didn't have this 500 billion social intervention fund going in for 6 years per year. You could imagine what the figure would have hit over 100 million people below poverty line. So it's not easy. people who are managing the economy are under stress, and they are not overly over dramatizing their success, but they are being much more modest about it. There are things being done. Okay, what's the government doing about the debt situation? Government, apart from the infrastructure company, government is exploring other avenues of funding the infrastructure and all that. That's why it's gone to pension fund. That's why it's created by Finance Act 2020, the unpaid dividend fund,
yes,
and these dormant accounts,
yes,
so that they can borrow against that, and they're even safer there, than where they were before. And then they're also looking at creating national savings fund that will bring more resources in, and then also reworking and rejigging and sweating government assets, putting more pressure on BPE to privatize a lot of those, and ICRC and their work, and then also looking to do other things that, like bringing the assets into the equation. Because at the moment, the narrative is that give me money, lend me money on my cash flow. And when they look for the cash flow, they say, but there isn't cash flow because all the cash is going into repaying debt. But nobody's looking at the asset. So everybody knows what you owe, but nobody knows what you own. So but when you start looking at assets and bringing them into the frame, then you see that you can get more money without overheating the creating fiscal stress. Now I can give an example. Saudi government wanted $25 billion. They didn't go to World Bank and IMF. They said, okay, Saudi Aramco is my company. How much is it worth? They valued it about 1.5 trillion. They'll give me 25%, well, 5%. 5% was 25 billion. That's fine. That's it. And they had the money that he had. We haven't been doing this on our assets. We need to do that. So that the assets, we are sweating our assets, we are moving the management of these assets to higher level and all that stuff, and then begin to borrow against some of these assets.
Prof, the MPC for the third MPC meeting for the year has kick-started today. It's going to hold today and tomorrow, and we expect the governor of the central bank, Godwin Emefiele, to reel out the decisions from the MPC to us tomorrow, I think at about 2 p.m. Now, what are your expectations? We have inflation at 18.12%, GDP 0.51%, and other metrics and parameters that the Monetary Policy Committee normally takes into cognizance before it comes to its decisions. What are your expectations from the meeting? Okay,
there are 3 key parameters that they think on. There may be other decisions. One is the cash reserve ratio of the banks, which at the moment is at 27.5. I don't think that we should increase that, because we still have loan to deposit ratio raised to 60%. Possibly it could go to 65, but when you add that to the cash reserve, they are substantially squeezed in terms of cash. And you've taken away those luxury money that they were using, the dormant account and all those hundreds of billions, they've gone away. So I think we should leave that. Then you look at liquidity ratio at 30%. I think we should still leave that, because we are in time of crisis. And you remember last year, CBN granted statutory forbearance to the banks to restructure loans and all of that. And even then, the banks have all been working hard, and then the loan to deposit ratio is improving, more liquidity is coming to the private sector lending, and then you also have non-performing loans coming down, heading to the 5% prudential guideline. Then even capital adequacy ratio is also improving for many of them, heading to 15% on this from above. So that leaves us with the monetary policy rate. Now, the monetary policy rate, I wouldn't want to change that where inflation is slowing. You don't know which way it is going to go. You want to see, give it another quarter to see where it's heading. Then the second one, of you've got the growth in GDP, marginal growth. You don't want to take any action that could send you back again into recession. So we just have to watch that. So if I was the MPC, I would say wait and see. Just give it another one to see which way elections are going to play. The main thing is this: the base ratio. Not ratio, that rate is always used to tame cash, the availability, liquidity. It's always used to tame liquidity. But the thing is this: the inflation is not actually caused by, in a large measure, by money supply, because there are 2 sides of money supply. money supply in the domestic economy. There's foreign exchange money supply, which is where we're having problem. Your policy here will not affect that. What affects that is the price of oil and the volume allowed to us to. We don't control the volume, we don't control the price. So, and then at the moment, we're not getting as much